Jonathan, I don't know that you saw the most recent economic numbers that came out this morning, but let's just say they are strong and maybe getting stronger. Specifically, I'm referring to Q1 GDP was revised up. Last report was 1.3, expected 1.4. It was revised up to 2. Then we got the weekly drumbeat of unemployment claims. We had been at 264, 262 for 3 weeks running. That 2 went down. I think it came in at 239. There's people that were calling for a, Q2 recession start, which I was one of them, and now have admitted I was wrong. Now everybody's talking about Q4. What if it just doesn't come? What if this soft landing or rolling recession means that maybe we have below trend growth, but the economy never goes negative? It seems to be defying gravity. What do you see out there?
Yeah, I mean, listen, we've been hearing this for a year now that we're supposed to have a recession. I mean, I've been reading that, maybe you saw this too yesterday or the day before, where a number of banks came out with their kind of predictions for the economy, and
I did.
the majority of them were predicting a recession, right?
Yeah.
So because of interest rate hikes, uh and yet here we are continuing to roll along. People are, kicking back their forecasts for a recession because the economy just continues to perform. And it is kind of mysterious. I mean, why with this rapid rate, rise in interest rates that we continue to do well. I mean, even as I was looking at Twitter, and there was a whole sort of discussion going on there about people simultaneously complaining about inflation and then going out and making like really big ticket purchases, right?
Yeah.
And so
Durable goods orders were up big earlier in the week as well.
yeah,
It's
but
just,
also vacations, like
yeah.
people are spending tons of money at the same time that they're complaining about the cost of everything. So
Yep.
like, what is going on? I mean, what we have seen, I don't know if this effect is big enough, but I mean, what we are seeing is that with inflation going down, real wages are up, right? Because the
Yeah.
real actual earning power is stronger because inflation, it hasn't been a
Yep.
whip, but it's definitely been, you've got
Yeah.
stronger wage growth than inflation right now,
Correct.
which is great. I mean, we should be like celebrating that, because it's better when everybody is earning more in real terms. But
Hmm.
that's also something that I don't think anybody was really expecting. And I mean, maybe that's why the economy continues to grow, because people are getting richer in real terms, even as all the news that they're hearing is bad, right?
Hmm.
And it's just noise, right? Because the reality is
Yeah.
there's no surge in unemployment. There's no decline in spending, and things are just chugging along, right? And
Yeah.
so, I mean,
Yeah. Yeah.
it's a little bizarre, but that's where we
Yeah,
are.
it's also very interesting because again, I just checked before we started recording. Again, GDP up, unemployment claims down. The 10-year note, last time I checked, was up 16 basis point, which is a wild move for a
Yeah.
morning. I'll see if I can pull it up now, but this is going to impact mortgage rates. It's up 13 basis points at the moment. But um, I think there's a lot of folks that are starting to believe that the Fed's going higher. I'm not in that camp yet. I do think CPI will shock people with their reading next week. We do get PCE tomorrow. We'll see what's there. I know core is stubbornly strong, but I'm willing to admit my call for a soft landing, which I thought was a joke at 5% 6 months ago. It's probably 20 or 25% today. So again, it's far from my base case, but I don't think it's out of the realm of possibilities like I did 6 months ago.
Well, there's always the issue of like capitulation, right? Like
Hmm.
that when everybody finally gives into the scenario of like, we're going to have a soft landing. I mean, that's when we have the recession, right? So,
Exactly.
like,
The
it's
masses, right? Yeah.
yeah, so it's the fact of the matter is that we just really don't know what's going on,
Hmm.
right? So, I mean, one possibility here is that, look, maybe the the Fed was fearful for too long about interest rates, about what would happen if they would raise them. The economy was much more resilient than they believed. You know, they got duped by Wall Street in 2018, 2019
Yeah.
when they tried to normalize things, and Wall Street screamed and yelled,
Mm.
and the Fed lost its nerve, and it
Yep.
it it reduced rates again, right? I mean,
I
that
remember.
that was maybe that was the wrong move for the Fed at the time.
Oh,
And then,
I think
you know,
clearly it was the wrong move, but
well,
yes.
but I mean, what I mean is like, but maybe they just didn't understand the resilience of
Oh,
the economy, right?
true.
And
Oh, I
nobody
can.
did, and maybe nobody does now, or maybe the truth is, and this is something that I believe for a long time, but I'm not an economist. I don't have data to back this up. This is more just sort of my own like intuition, which could
Right.
be totally wrong. But it's always been my intuition that higher interest rates are actually better for the economy, right? Because it leads to more
Hmm.
capital formation. It prevents people from, because, if you're getting a good return on your money sitting in the bank, you're going to save more money, right? And that means that banks have, they get those liquidity ratios up, they can lend more. Like, so what that the interest rates are higher? If it's higher across the board, it doesn't really matter. It gets priced into everything, right? So but it wasn't like when interest rates were higher that corporations didn't borrow, right?
Yeah.
They just had to make sure that they were getting a return, which meant that they had to think a little harder about what they were putting the money into. Like, we've had this economy for the last 10 years where, since money has been so cheap, like every dumb startup idea has gotten funded, right? Because the
Exactly.
money was free, right? And
Hmm.
so, like, I can't tell you how many, like, I ride the subway in the morning to get to my office, right? And you see a lot of ad campaigns on the subway
Hmm.
and you can tell that this is a VC backed thing, because the ads all look the same, right? No matter what the product is, they all have the same sort of formula. It looks like they're all done by the same ad agency, probably hired
Hmm.
by the VCs.
Hmm.
And oftentimes they're for ideas that are like, really? Like, really?
Somebody got money for that?
Yeah,
Yeah.
somebody got, and that this is not like somebody who just is, bootstrapping this, right?
Hmm.
They got money because they've got the money to go on the subway and buy ads, right? And so
Right.
the number of dumb ideas that have gotten funded over the last, like, so what if that goes away, right? It's not like that doesn't, the economy is not being driven by VCs investing in stupid ideas, right?
Yeah.
If that all goes away, nobody will even notice. It'll actually make people start thinking harder about whether the business is viable. And then, rather than, frankly, diverting all this cash into these dumb ideas, the
Yeah.
cash will get concentrated behind the businesses that really are viable and will really grow.
I
And that's better for the economy in the
I
long run.
actually love this idea. I think you're right. I think higher rates, it just forces better decisions.
It forces better decisions across the board, right?
Yeah.
We've talked about this before, but the risk-free rate of return. When the risk-free
Hmm.
rate of return is zero, right? When a treasury is paying you nothing, right, or 1%, you just start, all these insurance companies that are required to get 3%, right,
Right.
under their
Yeah.
mandate, right? They can't just put it in treasuries anymore. They have to go and they have to buy riskier and riskier assets, right? That just it what it means is
Well,
it's
that, and
all this money.
you start rewarding the operators, right? There's a big multifamily person who's all over social media that was celebrating buying it at 3.5 cap.
Yeah, I mean,
Yeah,
this is,
really?
yeah, this is, so you get misallocation of resources into risk assets, right? Because you get rewarded for making bets when
Yeah,
interest rates are
exactly.
low, because it
Yep.
creates a self-reinforcing, dynamic where, there's always the greater fool to buy because the interest rates are low, right? And so you get rewarded for what's essentially not productive behavior. I'm not saying it's bad behavior. It's certainly rational in that cycle,
Moment. Yeah.
but it is not healthy. It does not help the economy at all for people to be like trading in and out of apartment buildings, right? Or
Agreed.
trading in and out of houses, right? I'm not going to say flipping, because I actually one of those people who thinks that if you're going in and buying a rundown house and fixing it up, you're adding a lot of value, right?
Oh, no
I
question.
think this is
Yeah.
like a really, and it gets a bad rap, but I think it's totally essential. But going into like the apartment space, where you go and you buy an asset, you renovate 10% of the units, you sell it to somebody else as a proven value add, they go and renovate 10% and everybody makes $1 million. Like that's just dead weight loss to the economy.
Absolutely.
It doesn't do anything.
Absolutely.
That's not creating more jobs. It's just rewarding people for bets, right? So and I'm not saying that people shouldn't invest in apartments, and housing is important and it's a great way to build wealth and all that stuff. But what I am saying is that rewarding the flipping behavior, it doesn't really help anybody.
It's
Right?
financial engineering.
Yeah, it totally is.
That's what it
So
is.
it's when you have a higher interest rate, it just makes people think harder about making these decisions, and it sucks a lot of the speculation and just the betting out of the market, right? So I think it's good for the economy to have
I agree.
higher interest rates.
Yeah, just the last thing on this. I don't know if you watch the All In podcast. It's something I do while I go for my weekend run. I think his name's Bill Grundy, one of the guys that spoke last week. He basically talked about the 1,400 unicorns. So if you don't know what that is, there's 1,400 private companies that had $1 billion valuation. They call these unicorns. Highest number on record, blah, 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 like just all this crazy stuff. And he was pressed to give a percentage to how many of them will just simply disappear. He said 40%.
Oh,
that's 560 companies worth $1 billion at their last round that should not exist. That is risk-free money going after dumb ideas. That's exactly what that is.
Frankly, I'm surprised the figure is that low.
Well, again, he's in private equity, so he's going to go low.
Yeah. I would bet it's probably somewhere along the order of like 60 to 80%, right? Of those companies that will just,
most of them will never. So this is what'll happen. I've been through this cycle before in the .com crash, different names, different companies, same stuff. Half of them are going to go to zero, be gone. 30 or 40% are going to be bought for parts, right? Intellectual capital, this or that patent, whatever. And maybe 5 or 10% will exist as a public company or exist at all 2 years from now. And again, that's just capital that got lit on fire. Billions of dollars just lit on fire.
It's just the same thing as the share buybacks too.
Yeah, absolutely.
Right? Using all that free money that companies use to buy back their shares is great. They pass it on to their investors, but in terms of the health of the company, the stock price drops and it's all poof, it's gone. Right?
How about the companies that borrowed money to buy back stock?
Well, that's what I'm saying. That's what I mean. Yeah.
Not only cash from operations, but they had debt.
Right. But that's what they did. They issued debt, right, in order to buy shares back. Crazy. Right. And essentially all they did was they took money from one set of investors and gave it to another set of investors. Literally, it's just a funnel. Take it in as debt, give it back as buying back equity, right? You're just taking money from debt investors and giving it to your equity investors, and without adding any value to the company, without investing anything in R&D, in plants, in like productive capital, like anything, right? They haven't done anything. And now all that money is gone, because interest rates rise and the value of the stock goes down. And it's just people lining their pockets and producing nothing, right? So that kind of stuff goes away when you have to actually think about the cost of money.
Yeah, I look forward to the next couple of years. I know there's a lot of operators, owners of stuff who have bad debt structures, deals. If you're watching this channel, we've been raising cash for well over a year now. And we look forward to jumping in and adding some more assets. Jonathan, you run a great Facebook group. Where should the One Rental at a Time fans join?
Yes, well, please come on by to the Apartment Investors Club on Facebook, and you'll have to answer a couple questions. When you do, please let me know that you're from ORAD. I love to see it when folks come from this channel to that channel. Also, I would love to give you guys I'm giving you guys a heads up that I have actually started my own YouTube channel. It consists of the interviews that I do for my podcast. Nice. I finally got smart and realized that I should just be putting those videos up since I'm recording them anyway. So we just started a
good idea
channel. There's one whole video up now, but there are 13 in the queue waiting to get up, and it's where I interview like the great minds in multifamily real estate. So if you guys are interested in learning from those people, please go over there. There is currently a great video with my good friend and awesome businessman, Brian Burke. We just did a Q&A in my Facebook group, which we're also planning to do more of those in the Facebook group from here on in. But you can go to the YouTube channel for Apartment Investors Club and see that Q&A with Brian, which is really a great interview / Q&A.
There you go. Thank you very much, Jonathan.
Thank you.